in the areas of elder law, long-term care planning, trusts and estates, gift and estate tax planning, estate administration, and real estate. She graduated from Hunter College, from City University of New York, magna cum laude in 1981, and from Brooklyn Law School in 1984 as a moot court finalist. She was admitted to practice law in the state of New York in early 1985 and immediately opened her own law firm in Sag Harbor, and she's been in private practice there ever since. Meg is a member of the Suffolk County Bar Association, Wealth Council, which is a national organization of estate planning attorneys, and Elder Council, a national organization of elder law attorneys. She also serves and has served on numerous boards of directors and regularly contributes her legal services to assist local charitable organizations with formation and with fundraising. It is a pleasure to have her here with us today. Please welcome Meg Rudansky.
Thank you, Penny, and thank you all for coming out. This is probably the largest group I've spoken to, other than one, which was a group of about 200 Girl Scouts, which was quite an amazing experience to see a green. Apparently, this is a very important topic because we have such a large attendance, and I'm pleased to see that. So what I'm going to be speaking about today is residential options when you no longer can live alone by yourself, when you need the assistance of others to function. And as people are living longer and longer, the possibility of needing long-term care becomes greater and greater. And the sad truth is that 60% of all people over 65 will need some form of long-term care. And when I talk about long-term care, it really comes in three varieties. There's skilled care, which for the most part is really short-term care, but it can be a component of a long-term plan. So skilled care is when you need the assistance of the medical community in order to function. So a lot of times it's related to a particular illness, like cancer or heart problems, and you need the skilled care of nurses, doctors. The second, some of us will need rehabilitative care, and that again is short-term, but sometimes becomes part of the long-term plan. And rehabilitative care would come up in the context of broken bones, for example, where you go into a hospital and then into a different setting and you get occupational therapy or physical therapy. Again, both of those are typically short-term types of care that, the skilled care with nursing and doctors and rehabilitative with therapies. They're usually short-term care types of care, but they often can be part of a long-term care plan. But the care that's most often associated with long-term care is custodial care. And custodial care is basically when you need help with the activities of daily living. They're very often referred to as ADLs, activities of daily living. And there are 6 of them. There used to be 5, but now there's 6. And those are bathing and dressing and eating and toileting and transferring from one place to another. And so bathing, dressing, eating, transferring, toileting, and walking. And those types, when that's found, sometimes those are associated with a broken bone or with some kind of progressive chronic illness, but a lot of times they're associated with illnesses such as dementia or Parkinson's disease, MS, arthritis, where because of the nature of the illness, you no longer can function and perform these activities of daily living as you did before, and you become very dependent on the care of others. So when I talk about long-term care, I'm talking about a set of health care, personal care, social services that are required by a person who has lost or never required some degree of functional capacity. That would be chronically ill, the aged, disabled, and developmentally disabled. And that care is usually provided in an institutional setting or at home care. So I do want to say again that long-term care can be provided in home arrangements, assisted living, continuing care, retirement communities, and nursing homes. And these are just the most common. There are alternatives as well. But when you need the assistance of another to function, it can be very costly. And so that's really what this talk is about, is to really discuss what are the different options for living with the assistance of another, and basically how are you going to pay for it. And when we talk about how you're going to pay for it, we're talking about a variety of sources. Sometimes it can be self-pay. Sometimes it's relying on government programs like Medicare or Medicaid or the Veterans Program. Sometimes it's tapping into the equity of your home, such as with reverse mortgages. And also long-term care insurance has become another source of payment for this. So what I want to do right now is to focus on these different residential options, for example, home care, and then discuss each of the different sources of payment, whether it's self-pay or reverse mortgage, and see how that would fit together. Then I want to move on to assisted living, and after that, I would like to talk about continuing care and retirement communities, and then finally nursing home. And we'll look at each one and look at the various sources of payment that are available. And I'm hoping to speak about an hour, and then I want to open it up to questions to address any concerns that you might have. So I want to start with home care. And my experience with my clients is that if given a choice, people want to stay at home. They don't want to go into a nursing home. I've only had one client who actually told their children in my office that she wanted to go into the nursing home. But, so I would like to open it up to everybody. Is there anybody here that, if given the choice, if they needed the assistance of another person to function, would want to go into a nursing home? Yeah.
Excuse me.
Yes.
Actually, they're not as bad as they sound. They're not the right place.
They're the right place, and that's really key. And there are a lot of variables that will affect whether it's a good experience or not, and having family members by to be an advocate, that's another one. But the facilities, as we all know, have a range. And a lot has to do with their business model and their focus on customer service. Some of them are just looking at the bottom line, and they don't realize that customer service is such a key part to getting that bottom line up. But so as I said, rather than leave the home to get the assistance of others, most people would like to be able to stay at home. And it used to be that when I was sitting with clients, it appeared as though that was not an option for everyone. It was really an option for those people that could afford the high cost of bringing care in. But that seems to be changing. And some of the reasons that it's changing is, one reason is that Medicaid, and that's the system of payment for people that have run out of money, is starting to be a little bit more generous with the number of hours that they're giving. In the past, you would have an illness that required full-time care, and they would give you 5 or 6 hours. What that meant is, if you needed more than 5 and 6 hours, you would have to buy it a la carte. You'd have to buy these hours with your own money, and at $25 or $30 an hour, it became almost impossible for a large number of people to stay at home. So that was one thing that made healthcare more possible, is the fact that Medicaid was being more generous. Another one is an expansion of community services to support people. One particularly is daycare, and daycare for people with dementia, or people, basically dementia and Alzheimer's. That was a wonderful boom, because all of a sudden you didn't really need to provide for 24-hour care, because there would be town services to pick you up at your home, bring you over to the care center, and then you didn't have to worry about it. So the expansion of transportation and care services. Also, there's a growing trend towards reverse mortgages, reverse mortgages used to be a bad word. I don't know if you remember, but when they first came out, nobody would go near them. Now more and more people are thinking of it as an option, especially if it's a difference between staying at home and going into a nursing home. And the last situation is long-term care insurance, where, and we'll talk a little bit about all of these different options. So I'm going to talk a little about what home care is. It's basically care provided in the home. It could be your home, it could be a child's home, a friend's home. You know, as the baby boomers start to age, I think we're going to start seeing more and more, and by the baby boomers are aging, we are aging, but the idea is as we get into our, after 65 and 70, I think we're going to start seeing more communal type situations. Co-housing is something that's pretty big and it's starting to grow. It was very big in Denmark, and now it's coming over here where there's just common spaces shared by people living independently and supporting each other in a community. But home care is usually a combination of professional health care services. It can be skilled care at home. It could be rehab at home, and it also is custodial care. And again, we spoke about skilled care with the medical professionals coming in, nurses, sometimes doctors come to the house. Rehab, where they, where a physical therapist or an occupational therapist will come to the house, and custodial care, where somebody is coming in and helping with the activities of daily living, dressing, bathing, all of those that we spoke about before. And there's another layer of care, which is called personal care, where somebody would come in and do housekeeping and shopping and things of that nature. So what could that look like? Well, it could be intermittent care. It could be that there's just a visit from a personal aide on an intermittent basis, or a therapist or doctor or nurse or home aide. It could also include medical or psychological assessments, wound care, medication teaching, medication reminders, pain management, disease education, physical therapy, speech therapy, occupational therapy, assistance with those activities of daily living, meal preparation, shopping, and housekeeping. So that could be on an intermittent basis, where somebody would just show up, perform the services, and leave. Or it could be full-time. And full-time I see very often with one of two scenarios. One is where a family member, whether it's a child or a spouse or a sibling or a friend, moves in with the person needing the care, or the person needing the care moves in with the child, a family member or friend. And a lot of times it's full-time, it's 24 hours a day. There is, sometimes, however, it's professional care. And we'll talk a little bit about the cost of that professional care. When it's professional care and it's 24-hour care, it can either be a 24-hour, like one person is staying there for 24 hours, or it can be a split shift where somebody is there for 12 hours and the other person is there for another 12 hours. That would be in a situation where the person needs a higher level of care. They may get up in the night, they may need the assistance of somebody in the evening as well. Sometimes when there's home care, there's also the involvement of a geriatric care manager. And a geriatric care manager is a professional. Very often they have a background. There's geriatric care managing programs that they can go through and get certified. Sometimes they're social workers or therapists of other natures. And they come in and they really oversee the management of care. A lot of times if there's a child close by or a spouse close by, they can make sure that somebody shows up, make sure that the person in need of care is not being taken advantage in any way, and oversees the money. But sometimes there aren't family members, and if there's enough liquidity, enough assets that you can hire somebody who can come in, number one, do a home assessment to make sure that the home is a safe place, and also to make sure that everything is set up appropriately. But the geriatric care manager, in addition to doing the home assessment, can also come in on a regular basis and oversee the care of a professional caregiver. So now we're going to just sort of move from this idea of home care and all of its varieties and look at how the payment source for that. And the first one I would like to speak about is private pay. And home care is expensive. It's not quite as expensive as a nursing home, although depending on the care, actually it could be. If you needed split shifts, if you need, when you're paying two separate people, sometimes it can be very expensive. But if you can work through a private agency, you can work through a referral agency to find somebody, or you can hire somebody on your own. So when you're working through a private agency, they're getting a cut of the expense. And I've seen for local ones about $250 to $350 a day for the cost of having somebody come in for 24 hours. And that works out to about $7,500 on a 30-day month. It works out to about $7,500 a month. And I didn't do the annual, but I guess that would be about 90. Right? Any mathematicians here? 90,000 a year. So it's still less than a nursing home, which is going to be not $250 to $300 a day, but $375 and up, depending on whether there's a private room or a shared room. And that $375, by the way, that I just mentioned for a nursing home, that's really related to what I see out here in Suffolk County. If you went down to Shreveport, Louisiana, it would be significantly less. If you went up to Alaska, it would be significantly more. So the other way, we talked about a private agency. There are various private agencies that you can go to get somebody to come in to privately pay them. The alternative, one alternative, is going through a referral agency. And there are various referral agencies out here. The ones that I'm familiar with are places like the Polish Connection, the Lithuanian Connection, the Russian Connection. There are various connections out here, and exactly. And the positive part about dealing with one of these referral agencies, well, to explain, a referral agency is with these private agencies. You have an ongoing relationship with that agency. The agency is the employer. The agency will be paying. You pay the agency, and the agency pays the worker. With the referral agency, you become the employer. They refer people to you. If a person doesn't work out, they'll refer somebody else. So they have some ongoing role, but it's really minimal compared to the original, the private agency. Now, the positive thing about these agencies is that they're significantly less expensive. I've seen as low as $700, although I would imagine this woman's fees have gone up since she's, but I also see $800, $900 a week. And what you're dealing with when you're dealing with these connections are you're dealing with people that are coming over, many from Eastern Europe, and they have no place to go. So your home becomes it. There's no day offs. They come here not only with, this amazing work ethic, and I see it across the board. There's this incredible desire to do the job and go beyond anybody's expectations. The housewoman that usually is never cleaner, they usually cook phenomenally well. I know I'm generalizing, but for the most part that's been my experience. And so they're a lot less money, but there are some downsides to that. Some of them are not legal. And so that means that you have to take that, if you're going to take that on, you have some exposure there. Some of them also do not take a check, or they will only take a check made out to cash. So on one hand, you've got a very low cost, high level of care, but you have some exposure. Sometimes there's a language barrier. Sometimes there's no car involved. So these are some of the limitations of working that route. And the idea with paying cash is it's not a good thing, because ultimately if you're ever going to use the Medicaid system to pay for long-term care, and Medicaid is the program, the government program, where if you run out of money, they will step in, they'll provide home care, they'll provide nursing home care. When you apply for Medicaid, Medicaid wants to see whether you gave anything away to become as poor as you are to qualify for the program. And if they see these cash payments, it becomes a problem. So when somebody insists on going through these agencies, then I always say, if you're gonna, if a caregiver insists on being paid in cash, I usually advise people to have a log, to write down the date that the services were provided, the amount provided, and I have the caregiver sign. The other way of doing this is through direct hire. And the cost of that can be significantly less than, well, it's probably comparable to the referral agencies. It's really what the market will stand. And with today's economy, there's a lot of negotiation going on. And people find care on the internet. People put ads into the paper and look for them, either the person looking for a job or the person looking for the caregiver. So, so some agencies only have personal aides, and personal aides are the ones that deal with the activities of daily living. Some only have home health aides, and those are the ones that do the light housekeeping and the shopping. And others only have companion care, where they're really not doing anything other than companion. So I had mentioned before that you can pay by the day, but a lot of times people are in situations where they don't need 24-hour care, or they are getting some Medicaid hours, but it's not enough, and you can buy a la carte. You can go through an agency or do a direct hire. And those, I've seen anywhere from $15 to $30 an hour on that, depending on whether the person, with the level of care they need, and the agency, and the market as a whole. I find that just to give you a perspective, we're again talking about home care and how to pay for it, and we're talking now about private pay. And in a private pay situation, I always encourage people to do a budget. And with a budget, what you want to do is look at what are your monthly expenses, and with care and without care. So if you're going to bring somebody in and you know that you have to pay them $7,500 a month, or which is the high end, or something like $3,000 a month, which would be the low end, you add that to your other reoccurring monthly expenses, utilities, food, transportation, and you look and you compare that amount, that total amount, to your fixed income, the Social Security, the pension, the investment income. And there's usually a shortfall, because when you're getting care and bringing in an expense as large as $3,000, it usually, when added to your other expenses, brings most people over their monthly income. So then you have to say that on a monthly basis, if my expenses are $8,000 and I only bring in $2,000 in income, in fixed income, then I have to contribute $6,000 from my assets. And so that's something that is always important to do if you're going to do home care and you're going to pay on your own, is to see how long your assets are going to last if you have to dig into them, in this example, at the rate of $6,000 a month. And so it's a very important exercise, because it enables you to do the planning that you need to do. So if you only have $60,000 and you have to dig into your savings at the rate of $6,000 a month, you only have $10,000. So you need to think ahead and to say, what is the next step if I can no longer self-pay? And so there's usually a plan B that works when you're on the self-pay pay tracks, and that would be, to be able to segue into another form of payment like Medicaid, or in some cases move out of the house, have some people rent their houses out or portions of it. Also with family members, I saw this statistic as I was preparing, 74% of all caregivers at home are family members, and many of them serve without compensation. There is something called a caregiver's agreement, which is often a good way to go, because one path is to have all your money and spend it down and then go on Medicaid, and another path is to take your money and try to preserve as much as you can by transferring it away and then going on Medicaid, and that way you can save money for family members. And one way of doing that is having the child or a sibling come in and provide the care and pay that person. And so that's one way of getting money that is on your side of the ledger over to people that are significant and are playing significant roles in your life. There are some negatives. You usually have to put them on payroll. It becomes income to them. But even if you factor in all of the tax implications of that, it will ultimately result in savings rather than spending it down to a professional caregiver. And there is a wealth of community services out in the community to help people stay at home. One is the caregivers group, a caregiver support group, which is there to help caregivers, family caregivers. Another would be a support group for, I don't know if I mentioned this, but there are care groups for people with dementia. And that's just, I did mention that, and that's just an opportunity to tap into community services to support people at home. One thing that I did about 4 years ago is I decided that I had been planning for people for years and putting trusts together and helping people protect assets, but I really didn't know about all the services in the community to support my clients. So I started going out into the community and meeting with neurologists and Meals on Wheels and geriatric care managers and discharge planners at the hospital and town services for the aging. And I started going out, I realized we have an amazing amount of services. So I decided to put it together in a book. And the book, the end user of the book is the person with the diagnosis or their loved one. And there's a lot of information in here, and there are community services. This is about 4 years old, but I did bring, I brought about 50 of them. So, and I'm inviting anybody that would be interested afterwards to just come up and grab a copy. If you're here with somebody else and you can share, that's good, because I don't know how many people are here. So I have that. So now I want to talk about reverse mortgages. A lot of people self-pay and they run out of money. And so, and a lot of people, what I find is that there are a lot of millionaires out here. There are a lot of people that have wonderful homes with no mortgages on them, and they have access to, they have all this equity. And the problem is they need to access it. So reverse mortgages are a particularly interesting way of accessing the equity in your home. And it's a particularly good option for those people that are not particularly, they don't care as much about preserving as much of an inheritance as they would like for children or other beneficiaries. It is a mortgage that allows you to tap into the equity of the home. You can use that money for whatever you want. There's no repayment while you're alive and you're living in the home. And there is, and the money can be used for anything in particular. It could be to repair the house, to take a vacation. So certain things have to be present. You must be 62 in order to get the reverse mortgage. but there are no minimum income requirements or asset requirements or credit reports. They don't look at they're looking basically at the value of the home. If you're going to get a reverse mortgage, you really need to attend a mandatory counseling session because there are some downsides of it, and the government wants to make sure that everybody is knowledgeable about the positives and the negatives. The amount that you can receive with a reverse mortgage depends on a variety of factors. One would be the value of the home. The second would be the interest rate and the age of the borrower. They also require that you pay off any existing debt. They want to be number one on the list of creditors, and so that's one of the requirements. Sometimes that's something that precludes its use, because if there's a lot of debt on there, and they only give you $400,000 and you need to pay off that debt, you have no net. So, but also some people like doing it for that because they have a regular traditional mortgage with monthly payments, and if they do pay off that debt, they swap those monthly payments for no payments, payments that are ultimately going to be due when the house is sold, or when you die, or when you move out. So there are different ways of getting reverse mortgages. There's different ways of payment from the reverse mortgage. Some people get a lump sum, and anything that you take, whether it's a lump sum or monthly payments, you're only paying interest, or the interest is only accruing on the amount you take out. So if you take out $400,000 and you put it in your own bank account, immediately the interest is starting to accrue on that amount. And so when it's ultimately paid off, you have to pay off the original amount that you borrowed, plus interest, not only on that original amount, but also on those monthly payments. Tell me, does anybody have any questions about that? I don't know if that was clear. Yes?
Is there an upfront cost?
Yes, and it's quite high compared to a traditional mortgage, but I'm seeing that traditional mortgages are not as inexpensive as they used to. And so I was looking at, for one client, we looked at a traditional mortgage and a reverse mortgage, and the traditional was $12,000 to borrow the $500,000, and the reverse mortgage was $22,000. So it is significantly more. But for the person that doesn't care about leaving as large an inheritance, or if the value of the home is so high that $22,000 doesn't look all that big, then it's clearly an option. And it may, in some cases, be the difference between staying at home and not staying at home. Yes?
The interest is due only when you die, and the amount has to be paid.
Yes, but that's partly true. There are 3 conditions under which the bank can call the loan. One is upon death. The second is if you sell the house, because it is a lien on the house and it will have to be satisfied on the date of sale. And the third condition is if you move out, like if you went into a nursing home, because one of the conditions for getting this mortgage in the first instance is it must be your primary residence and you must live there. So if you move into a nursing home, then all of a sudden they have the right to call it. I don't see how they would ever find out, but you never know, and that is one of the conditions.
You pay no interest unless one of these things happens.
Yes, but the interest, you get statements on a monthly basis, and you start to see, well, the monthly payment would have been $2,200, for example. So if you borrowed $400,000 and the monthly payment is $2,000, let's say, then the next month you're paying interest on $402,000. So it compounds, and you're paying, and it does grow very fast. You're never going to be liable for more than the value of the home. So it's not like they can come after you if there's a shortfall. Well, if you're deceased, they're not going to have much luck coming after you. But if you move out or you sell, they can't come after you for the excess.
Do people, from your experience, have people outlived, the value that was that far?
So in other words, if they had taken out $400 and they consumed that full amount, I haven't seen that happen, but I can't imagine that it would, I'm sure it does happen. in
And
some
what would
circumstances.
happen in that case?
Well, it all depends. It seems like the lending limit keeps going up. Like in 2008, it was 400, and 2009, it's now over 600,000 as a lending limit. And so if that happened, that you ran out and there was an increase in the lending limit, you would always have the ability to refinance the reverse mortgage. But nothing is due again until one of those 3 triggering events occur.
So at no point do you have to actually pay them that interest?
You're not paying it unless, your estate would be paying it in most cases, or you would be, or it would come out of the sale proceeds, if the house was sold. Yeah.
How is the value, assuming you want to borrow less than the value of the house, how do they assess the value of the house?
They do an appraisal with another cost.
What is that? Is that typically?
It's fair market value. Yeah, but I find whenever you borrow money from a bank, their version of fair market value is far different than most people's, and it's usually significantly lower because that they want to be able to cover the cost of their of the loan in the event when the loan is repaid. The last piece about that is that there are different ways of taking out the money that's freed up once the application is complete. So one way we just spoke about before is taking that lump sum out. And they really like that because you're taking out a huge amount of money and the interest is starting to accrue on that full amount. The other is similar to a home equity where money is freed up, but you take it out as you need it. And when you take it out, that's when the interest is only accruing on the portion that has been taken out. And the last way is by setting an annuity, where you basically agree, and my understanding is that it's fixed. So you say, I want this annuitized, and then they start sending you the monthly payments. I believe it's over your life expectancy. So it may be that you authorize them to give you $1,500 and it shows up on a monthly basis. So those are the 3 ways of taking care of it. They all have their own interest rates and closing costs. It varies, and it's a little friendlier when you're taking out the larger sum because they know that they're going to be getting more from that. Yes?
I have 2 questions on it. What happens if you take out a reverse mortgage and based on the fair market value, and then 5 years later when you die, that the fair market value has declined? So maybe I took out 400, but my house is only worth 200. The lender is on the hook for that?
No. The lender is not on the hook.
Okay.
You don't assume any personal liability. The borrowers, the lender is on the hook.
Okay, that's the lender's loss.
Is on the hook.
Okay, so in this market, for example, that might be the case. Now, what happens if it's just the opposite, and my house has gone up substantially, so I borrowed the 400, but now it's sold for 800? Does the estate get that, the rest of it?
Yes, and
So it's only for what you-
overage would just go to the estate. It'd be, yes. So it's treated like any ordinary debt, whatever the value is
Okay.
paid. So I want to talk
One
briefly.
thing.
Yes.
You don't get the full value of the house, right? You
No,
get a
the
percentage.
maximum amount is somewhere around 600,000. They give you a percentage of that. But the maximum, if your house is worth $3 million, they'll make the assumption that it's only 650. So long-term care insurance, and that's another one. I think it's a great product, but you have to be able to afford it, and you have to be insurable. And as a lot of people think, well, you should take it out younger. When you're younger, the premiums are significantly lower than if you wait till you're 75 to take it out. But I've seen some things showing that, some studies showing that ultimately you're paying the same amount. The only advantage to taking it out younger is that when you get to the point where you're on fixed income and you're retired, it's nicer to have those smaller payments. So there is some advantage to, and also as you get older, the possibility of having a higher rate because of some kind of condition. A lot of times that would affect it. So,
Excuse me.
yes.
Are you going to, at some point today, speak a little bit about some of the peculiarities of different types of long-term health insurance? Because I've read a lot about it, and to me it's a very, very, very complicated subject. There's all different kinds of policies, and there's all kinds of pitfalls, and you can never get a straight answer from anyone who's selling it to you. You've got to get it from someone who's like yourself.
Right. That's my feeling also. Anytime you get a long-term care policy, you should always have it reviewed before you purchase it, because you're dealing with somebody who has a vested interest in seeing that policy be sold. And I've seen so many inappropriate policies. Maybe we can leave that towards the end, because I'll have a half hour of questioning. And yeah. So I just want to talk that the policy is usually triggered when a person cannot perform 2 out of the 6 activities of daily living. And there are different factors that are going to affect the premium. So one is an elimination period. And this is, it's kind of like a deductible. So some policies have 0 elimination period, and some have 100 days. Those would be the 2 extremes that I see. And if it had a 100-day elimination period, it means that the policy, once you call the company and you say, I can't perform 2 out of the 6 activities of daily living, then that starts the clock. And if you have a 100-day elimination period, then that means that you're paying privately for 100 days. So it's kind of like a deductible. The other thing that will affect premiums will be that the extent of the premiums. Some policies pay for 3 years, some pay for 5, some are indefinite, and clearly that will affect the cost of the premium. The daily rate, some policies will pay, depending on the option that you choose, $250 a day for a nursing home, or only $100 a day. And clearly the amount of that daily rate is going to affect the cost of the premium. And that's an example of something that I see. Sometimes the salespeople are so intent on closing the deal that they reduce that monthly premium, the daily rate to $100, when out here it's $375 in the Hampton Rehab Center a day. So that means they have to come up with $275, and their income doesn't support it, and their assets don't support it. So sometimes it's more intent on closing a deal than it is about really finding an appropriate policy. And the last issue with long-term care is that, and this is the last variable that's going to affect the size of the premium, and that is a 5% inflation rider. So if you get a policy right now that pays $250 a day for a nursing home, and you say, well, I have enough income to supplement that, and that's fine, but you don't need a nursing home for 10 years, and all of a sudden the nursing home is no longer $375 a day, but $600 a day. Now you have an inappropriate policy that's almost useless in the context of a nursing home. And so one feature is having a 5% inflation rider. It is the one variable that causes a steep increase in the value of the premium, the cost of the premium, but it is also a very, very valuable one. And that can come with simple interest or compounded interest. Again, that would affect it. So we just spoke about long-term care and as a source of payment for staying at home. And Medicare is another source. And I'm going to speak somewhat rapidly at this point and hold the questions till the end because we only have a limited time. But because I want to leave about a half hour for questions. But Medicare, most people don't realize, but Medicare doesn't pay for custodial care. So if you had dementia, if you had Parkinson or arthritis, and you didn't have the need for any skilled care, a doctor, a nurse, a physical therapist, then Medicare is not going to pay for the services. Medicare does pay for skilled care and rehab. We spoke about that earlier. So if you have cancer, or if you had heart issue and you were in and you needed the assistance of somebody in the home setting, whether it's a doctor, let's just say a nurse or a physical therapist. So again, with skilled care or rehab, where you have a broken hip, something of that nature, Medicare will pay for people to come to the home. It will be intermittent services. It may just be somebody showing up for an hour and taking blood pressure and administering medicine. It may just be somebody coming and do physical therapy. But if you just need help with the activities of daily living, dressing, bathing, they will not pay for it. If you do need skilled care, or if you do need rehab, they will then add on a little bit of personal care, but you need to have that predicate of skilled or rehab. So in order to get Medicare, you need to have a signed care plan by a physician. You need to be homebound, and they're not entirely strict. You can go out with the assistance of another, but if you're basically homebound, if you need skilled care or rehab on an intermittent basis, and if the services are provided by a Medicare certified person, then Medicare will pay. And what's covered is nursing services, therapy, some limited home health aid, and durable medical equipment like special beds or the scooter. Everyone's heard of the scooter store, and you know, scooters are covered, and they know that, and they have a great marketing plan. So now I want to talk just briefly about, and I'm going to speak about veterans benefits, and this is largely unknown. A lot of people don't know that veterans, the Veterans Administration will pay for, they will actually give you a pension or an actual check on a monthly basis if you need help with the activities of daily living. There are certain predicates. One, you have to be a veteran or a surviving spouse of a veteran. You have to have served 90 days of active services, and one of those days has to be during active wartime. So active duty, 1 day at the beginning of a period of war, and that's not true, obviously, of the surviving spouse. The surviving spouse also has access to these benefits, and they don't need to meet that other benefit. The veteran is eligible up to $1,519 a month, and it shows up as a check, and it can be used to pay for care at home. If the surviving spouse is entitled to a maximum, that is a maximum, that $1,519. It all depends on your other income. They have a formula that determines how much of that $1,519 you can get. The surviving spouse has a maximum of $976, and this is all money that just can make staying at home much easier on the pocketbook. In order to qualify, you can't be too wealthy. So you can have $80,000 in assets. You can transfer your assets to become eligible. So if you have $150,000, you can take that extra $770,000 and transfer it to a family member. And unlike Medicaid, which we will speak about soon, there is no transfer penalty. So you can transfer it day one and get it the next day. I want to talk a little bit about Medicaid. Yes?
Well, first of all, the active duty means you have to be up front, or you have to be in the service.
You have to be in the service. You have to be enlisted.
And if one spouse has Parkinson's and the other one just needs care, and the Medicaid care program, they'll come to the house when someone's spouse has Parkinson's. Does it make any difference?
One has Parkinson's and the other...
One just needs some skilled care.
Yeah, they will come in, the Medicaid will come in for the, yes, I'm going to hold all questions right now because we have 10 minutes more on the...
We're filming this, and it's 1 hour, we're getting it to channel 22, that's our limit. You can stay after and have questions.
Yes, and we'll have a half hour's worth of questions. So Medicaid, I want to talk about Medicaid, which is the system that pays for home care, nursing home care, and it pays for it, but you have to be poor. It's a combination of a federal, state, and county program. Each of these different government entities will contribute a certain portion, but it also means that there's federal law, state law, and county regulations that need to be complied with, and it's very complicated. Now, Medicaid will pay for home care. It used to be that they only paid, as I mentioned before, a couple of hours. Now they're paying, I've been seeing a lot of 24-hour cases opened up. You have to be poor in order to qualify, and the Medicaid's version of poor is that you can't have more than $13,800. You can have a house, as long as it's worth $750,000 or less. If your house is greater, you can always take out a mortgage. And you can have $13,800. You can have a house. You can have a car. You can have a prepaid funeral, and you can have a small little life insurance policy that doesn't have a face value of greater than $1,500. And you can have the things in your life, jewelry, no hope diamonds, but you can't have jewelry. And so how do you get to be that poor in order to qualify for Medicaid? One is that you're naturally poor. The second is that you spend all your money down on medical services or other things, and you become poor through the spend down. And the third one is that you do advanced planning, where you transfer things that can be transferred into a trust, transferred to children. Okay, I want to move on very quickly to assisted living. I'm going to wait till the end.
What was the price of the house that you could?
$750,000.
700.
Assisted living, I'll just talk briefly about it. It's just where it's sort of if you look at a continuum of care, you're independently living, and then there's assisted living where you get assistance with activities of daily living, but you don't quite rise to the level of needing a nursing home. And those I've seen in the range of about $2,500 a month to $7,500 a month. Actually, some of them are higher because more and more of them are bringing in higher level of services. And there are a lot of add-ons. You have a basic contract price, and then you start adding on. Basically, there are all different types. There are chains, there are mom and pop shops, and some of them offer higher level of services than others. It used to be a general rule that if you couldn't walk, you couldn't be in an assisted living facility, but now I'm seeing more and more of them have accommodations. Of course, you're paying for that extra service. Reverse mortgages don't work in the context of assisted living because you have to live at home in order to be able to access the reverse mortgage money. And if you move out into an assisted living, the mortgage company could call the loan. Medicare doesn't pay. There are 2 assisted living facilities in Suffolk County that actually are paid for by Medicaid, but for the most part it's private pay. There's also the next one I want to speak about very briefly is continuing care communities, such as Peconic Landing. A lot of people call that aging in place. Very often you go in as an independent liver and you move into an apartment or into a standalone type of house. And if you need a higher level of care, there's an assisted living facility on the campus, as they call it. And then there's also a nursing home. So the idea is that you're aging in place. And it's particularly nice, I think, for spouses, because a lot of times if one spouse needs a higher level of care and they can't live alone, sometimes they're separated by many miles, but if you can have the assisted living on the same campus as the home, it makes it a lot easier. Also, even if you don't have a spousal situation, but you are a very social person, you go into this community, you make a lot of friends, and all of a sudden you need a higher level of care where your friends are very close by and it's very convenient for them to visit with you. And the cost of these can be very high. There's usually an entrance fee, there's usually a monthly fee. The monthly fee is set, And I know with Peconic Landing, I think it's somewhere around 4,000, which you pay as an independent liver. And if you go into the assisted living, your fee stays the same. And if you need a nursing home, which is typically $12,000 a month, you're still paying the $4,000. But they are very expensive, and they do have very strict financial requirements before you enter. The last place that I want, the housing option, when you need the assistance of another, would be a nursing home. And private pay, it's about $375 a day for the Southampton Care Center, Rehab Center. West Hampton Care is the same. If you want a private room, it's $400. That annualizes at $136,000 a year for the double and $146 for the private. You can see if you're going on the private pay route that you can really run out of money significantly, very quickly. I do want to mention also with Medicaid for home care, if you transfer everything away, you don't have a 5-year wait for Medicaid home care. You can take everything you own and transfer it away, and the next month apply for Medicaid home care. And as I said, now they're opening more and more 24-hour care cases. So it's really a wonderful thing in a lot of respects. New York is very different than a lot of the other states, so you may hear from family members or friends in other states that this is not available, but New York has very liberal home health care rules. There's no waiting period if you transfer your assets. But if you were to access Medicaid for a nursing home, you would have to, you have to plan ahead. There are certain, so in other words, Medicaid will pay for a nursing home, will pick up the whole amount. It's $136,000, which is the private pay. Medicaid pays significantly less for it, but you don't have to pay anything if you qualify for Medicaid. And one way of qualifying is in a spousal situation. Well, let me start by saying that if you transfer all of your assets to a child, you basically have to wait 5 years before you can get Medicaid. There are exceptions. So if you transfer everything to a spouse, there's no waiting period. There's no, they provide an exemption for a spouse. And the spouse is only allowed to have something like $109,000. So if the spouse, after receiving the transferred assets, has an excess of $109,000, they can sign a spousal refusal, and the spousal refusal will allow them, allow the applying spouse to get Medicaid. Medicaid could conceivably come after the refusing spouse, but as a practical matter, it's not happening very much at all throughout the state, and it's specifically in Suffolk County, it's not. And then, so I did want to also mention Medicare. Medicare will pay for a nursing home, but only a skilled nursing home. So if the only illness is Parkinson, or the only illness is dementia, and you just need help with the activities of living, but you don't really need the services of a medical professional or rehab, then Medicare will not pay a penny. They will pay if you need skilled care or rehab. There are certain conditions that must be met. You must be in a hospital for at least 3 midnights. And your entry into the hospital must be because you need skilled care or rehab. You must be released from that hospital into a skilled nursing facility within 30 days from your discharge from the hospital, and Medicare will pay. They pay 100% of the first 20 days. Of the second, of the day 21 to day 100, they only pay 80%, and they sometimes that extra 20% is picked up by a Medigap policy such as AARP, and that you're not guaranteed that 100 days. So if they feel that you're plateauing and you're not benefiting from the care that's being provided, they can stop it, which can be appealed.